Hey, what's up everybody? Tuesday, November 19th. So, I think we are reaching a level here in the stock market where the risk of a pullback has risen pretty substantially. And the reason why I say that is because I've noticed anyway a rise in bullish sentiment. I mean, when I look at things like put-call ratios, when I look at the headlines even, they have become much more bullish, much more optimistic. I see anecdotal evidence of that all over. Headlines predicting, a further rally in stock prices. Now remember, this whole entire year has been nothing but doom and gloom. We had the trade war situation. We had the inverted yield curve, remember? We had the liquidity crisis that the Fed had to respond to. The recession fears, which by the way I said to you all along there's not going to be a recession. I mean, all those things have kind of melted away. They're not there anymore. And each and every time, and we had corrections in March, we had corrections in May, we had corrections in July. I said each and every time all those fears were not just overblown, they were unsubstantiated. There was no basis for them to be there, but that's the media. But now I see things turning around. And as a matter of fact, today, interestingly enough, somebody sent me an article about, you may know this guy, he's a big hedge fund operator, Paul Tudor Jones. He's now saying that he thinks the stock market's going to go on an explosive rise. Now, he's saying that now. Now, here's a guy who for months and months and months, all this year and even beyond that, the guy is wringing his hands and he's so worried and talking about the deficit and the debt and the government spending. Like, here's a guy, and I know he manages a lot of money, a lot of these guys do, but it doesn't mean they're smart. It doesn't mean they understand the monetary system. They know how to raise money from their rich pals and institutions. All right, I give him credit for that. But I mean, here's a guy who is completely misinformed, out of paradigm when it comes to understanding how our monetary system functions. I mean, the guy, has been going on and on about the debt and the deficit, and I'm pretty sure he missed out on this, at least a good portion of this stock market rally this year, if not the entirety of this rally. And now he's saying, I think it's going to go on an explosive rally. So you start to see things like that. And somebody else sent me something today telling me, I don't know if it was JP Morgan or Morgan Stanley, one of those firms, they were bearish and now they're flipping to positive right now. Now they're flipping bullish. So I think the climate right now, the environment is ripe for a pullback. Now let me say this, that in the big picture, and this is what I do, the macro situation, the fiscal support to the economy is so large that we're just going to the economy is going to continue to expand. Maybe the growth is not going to be fantastic. We might settle in around 2% because there are headwinds. You still got the trade situation going on. You still got a labor shortage, or not still, we're heading into a labor shortage right now. You've got inflation rising up. So I mean, you even could say Fed monetary policy right now is kind of constraining. So the stock market's not going to go on an explosive rise. It's going to be a continuation of the way it has been, which just confounds and confuses so many people. They can't stay long the market because every dip looks like it's going to be the next 2008, 2009. Now, if you understand what's going on, as I do and my subscribers do, you know that this massive fiscal support, which by the way is not going to go away, it's not going to go away for many years, because the main pillars of those fiscal supports, you're talking about non-discretionary things like Social Security, Medicare, Medicaid, and to a lesser extent, defense. And I say lesser not in magnitude because it's enormous, but lesser in the fact that it is a discretionary spending item. But under Trump, he just keeps increasing defense spending. So at least not until next year with the presidential election, we see who we'll get. And even if a Democrat is elected, I doubt very much if they're going to cut defense spending by any significant amount. So you got these four things, which are the pillars, the main pillars of fiscal support. And they're going to continue to grow, especially the three I mentioned, Social Security, well, Social Security and Medicare for sure. All right? They're going to continue to grow for years because, as I've said, the baby boomer generation is just now coming into retirement age, and so the roles of recipients just keep increasing and increasing, and that's going to go on for. I mean, I've seen estimates where it could go on for another 3 years, another 5 years, even another 10 years until it peaks out. Very, very powerful. But so the big picture is that the economy is going to stay supported. The stock market's going to go up because corporate profits are going to continue to expand. Maybe sometimes a little faster than other times, but it's going to continue to expand. But you can trade these moments when, things get a little bit too optimistic. The market runs ahead of itself. You can trade these moments. Now, I had that in my report, MMT Trader. And of course, I'm the information in that, and if you haven't signed up yet for a 30-day free trial, I really suggest you do it, because January 1st, it's going up to $395 a month. And it's currently $250 a month. It's really, really cheap. And eventually, I'm pushing it up to $1,200 a month. And even that, I mean, this is a resource that you cannot find anywhere else. Period. It's not just the MMT understanding and the application of the MMT, but it's also what I teach and coach in terms of mental game. This whole thing is mental. I've said that a zillion times. I mean, this is hard. Mentally, from a stress standpoint, I mean, this is a hard, it's not hard really to make money, but it's hard to manage your mental state properly. And that's what it's all about. By the way, let me just say this. We shorted oil up around 58. Now remember, for 24 weeks straight, I was saying you got to be long. We were long at 52. We were long at 53. We were long at 54. We were long at 55. We were long at 56. Up around the high 57s to 58, I told my subscribers to sell. We're short now. And the reason we did that was the first time in 24 weeks that we saw commercial participants in the oil market flip to net short futures. They were net short. They've been long the whole entire time for the last 24 weeks. Every time the market dipped, they were down there buying, and we were buyers too. They got short at the top, and we went along with them and got short at the top. And you see today it's down at the 55 handle, and it's going lower. At some point it'll be a buy again, I believe, but we caught that nice move. Again, this is all in the report. So yeah, and of course, if you trade Forex, look, we just had the API oil inventories that just came out. I mean, Forex you can use as a fantastic proxy to trade the oil markets. I send out updates on that every week. So if you want my daily Forex signal service, Zombie Trading, go to my website, pitbulleconomics.com, and sign up. Got to get this stuff, folks. All right, that's it for today. See everybody tomorrow. Bye-bye.